They launched their most potent assault. They bided their time until the cloak of night descended. They elevated the capital requirements. They deluged the trading platform with synthetic short positions. They dyed the ticker tape crimson as the weekend approached. For a duration of 48 hours, their objective was to convince you that the surge in silver prices had concluded. They wished for you to accept that the collapse had materialized. However, as the sun ascended over London this morning, the lingering effects dissipated, and the bullish sentiment remained steadfast. We have just been privy to one of the most impactful market indicators of the past decade. It was not a formal declaration from a news conference. It was not an official decree from the Federal Reserve. It was the very movement of prices. The market did not merely rebound, it surged spectacularly. The substantial upward price gap we are observing, which obliterates the losses from the preceding sell-off in a single trading period, is far from typical market behavior. It is a powerful declaration. It signifies the sound of a bearish maneuver backfiring, ensnaring the financial might of the world's largest banking institutions. It is the audible confirmation that there is no tangible silver available to back their leveraged paper investments, and it unequivocally validates that the strategy of acquiring assets during a downturn has transitioned from individual investors on social media forums to national governments and major industrial corporations. Should you have succumbed to panic and divested during the decline, I bring you unwelcome tidings. You provided the liquidity they required. You served as the propellant for this ascent. But should you have held firm and comprehended the underlying dynamics, you are now witnessing your foresight vindicated in real time. Within this detailed market examination, we will not be delving into forecasts. Instead, we will scrutinize the scene of the alleged manipulation. We will meticulously deconstruct precisely how the financial institutions attempted to suppress the price and the reasons why, for the first time in 4 decades, their strategy faltered. We will elucidate the mechanics behind the swift recovery in price and clarify why this specific pattern indicates that the lowest point has been reached. The synthetic price attempted to deceive you. The physical market, however, conveyed the unvarnished truth. This is an autopsy of a failed market downturn. To grasp the intensity of this price escalation, one must first understand the trap that preceded it. In the realm of financial markets, progress is rarely linear. Ascending markets are engineered to unseat participants. Their design is to inflict maximum discomfort upon the greatest number of individuals. What we recently observed, the abrupt and precipitous decline that instilled widespread apprehension, was a textbook example of a bear trap. Here is a breakdown of its operational mechanism. The financial institutions are privy to the locations of stop-loss orders. They are aware that numerous individual investors have established automated selling directives positioned just below key psychological price thresholds, such as $60 or $62. To secure liquidity, these institutions must trigger these specific orders. Consequently, they employ a precipitating event, such as an increase in margin requirements or a concerning news headline, to drive the price down just sufficiently to activate these triggers. Click. The stop-loss orders are executed. The individual investors automatically sell their holdings. The price action forms a visually alarming red candlestick. This convinces bearish speculators that the prevailing trend has been disrupted. They then enter the market aggressively, initiating short positions. They wager heavily that silver will recede to $50. However, the trap then closes because the financial institutions are not selling to exit their positions. They are selling to acquire assets. They depress the price to generate the necessary selling volume, and then they absorb it all. They purchase the contracts from the distressed individual investors. They acquire the contracts from the overconfident bearish speculators. Once they have fulfilled their accumulation objectives, they withdraw, ceasing the artificial downward selling pressure. The inherent demand then takes effect, much like a compressed spring releasing its energy. The price accelerates upward. It opens with a significant gap overnight, leaving those who sold at the bottom holding unwanted cash, and those who initiated short positions at the lowest point are now facing losses. They are compelled to engage in panic buying to cover their deficits. Their purchasing activity further fuels the upward momentum. This is precisely the sequence of events that has transpired. The price drop was manufactured. The recovery is authentic. The ferocity of the upward movement is a direct indicator of the underlying market's strength. Weak markets exhibit a mere flick, akin to a defunct feline. Robust markets conversely rebound with vigor, reminiscent of a bouncing tennis ball. Silver has just demonstrated a rebound akin to a Super Bowl. We previously discussed the margin call crisis, whereby exchanges increase capital requirements to necessitate selling. Historically, this represents the ultimate leverage. In the year 2011, this tactic proved highly effective. Margin requirements were escalated, leading to a 30% devaluation of silver within days. This deterred speculative activity for a decade. They attempted this strategy once more. This time they increased the cost of engagement. Their intent was to render holding a position prohibitively expensive. Initially, it appeared successful, with a dip in price. However, an unprecedented event then occurred. The market absorbed the impact. The reason for this resilience? The fundamental composition of the market has undergone a significant transformation. In 2011, the market was predominantly characterized by speculative holders, often employing 20-fold leverage, who were unable to meet margin calls. Upon notification, they were compelled to liquidate. Today, the market is dominated by substantial holders. These include industrial consumers, family investment offices, and sovereign wealth funds. These entities are not engaged in speculative ventures. They are engaged in securing supply chains and safeguarding wealth. They possess considerable financial resources. When the exchange stipulated increased capital is now required, these purchasers did not divest. They transferred the necessary funds. This represents a calamitous signal for those seeking to manipulate the market. It signifies that their calculations regarding pain thresholds are inaccurate. They had anticipated that a 50% increase in margin requirements would break the bullish trend. Instead, it merely incited the market's defiance. When a market disregards adverse news or regulatory pressures, it indicates exceptional underlying strength. It signifies that purchasers are not deterred by price, but are rather influenced by volume. They prioritize securing the silver over the prevailing margin requirements. The inability of the margin increase to precipitate a sustained downturn serves as a clear signal for the next upward trajectory. The financial institutions have expended their decisive measure and now find themselves with an ineffective strategy confronting a formidable market force. Let us examine the psychological impact of this on the market. Markets are driven by two primary forces, avarice and apprehension. However, there exists a third, more potent driver, regret. The pronounced V-shaped recovery, characterized by a price decline, followed by an immediate rebound to new peaks, functions as a regret-inducing mechanism. Consider the individual who divested on Friday. They were apprehensive. They observed the negative price indicators. They believed they were acting prudently, thinking, I will sell now and re-enter at a lower price, perhaps $55. They retired with a sense of security. Then they awoke on Monday to discover that silver's price had surpassed their selling point. They did not achieve savings, they forfeited their position. Now they face a critical decision. Either admit their misjudgment and repurchase at a higher valuation, or persist in waiting, hoping for another market downturn. The majority opt for the latter, refusing to re-enter at an elevated price. They witness the price ascend to $65, $68, and $70. The lingering regret evolves into a fear of missing out. Ultimately, they succumb to panic and re-enter the market at its apex. This is the genesis of market bubbles. The preceding shakeout removes the less committed participants early on, lightening the load for more efficient progression. It then compels hesitant individuals to pursue escalating prices. This recent volatility served as a cathartic event. It purged excessive leverage. It recalibrated market sentiment. It transformed overbought conditions into neutral territory without fundamentally disrupting the established trend. From a technical standpoint, it was a masterclass in market architecture. Regardless of whether it was a deliberate orchestration by financial institutions or a consequence of natural market fluctuations, the outcome remains consistent. The path of least resistance is now upward. But who was responsible for acquiring assets during the dip? It was not the retail investors. Retail participants were exhibiting caution. The volume data reveals a different narrative. The purchasing activity commenced in Asia but intensified in London. This is a pivotal element of this situation. For many years, London has been the primary source of supply. It has functioned as the ultimate seller of last resort. However, this morning, a significant shift occurred. London changed its stance. In the subsequent segment, we will investigate this pivotal shift in London's market behavior. We will examine the reasons why the bullion banks in the United Kingdom, traditionally instrumental in suppressing prices, are suddenly engaged in frantic acquisitions of physical metal. We will explore the prevailing rumor that available supply has reached its lowest point, and we will elucidate why this alteration in institutional conduct virtually guarantees that previous price peaks will be surpassed. The bear trap was merely the preparatory phase. The London pivot represents the catalyst. Remain with us. We must address the matter of available supply. For those just joining us, let us recap the critical events. Friday marked the aggressive price suppression. Sunday night witnessed the significant price gap upward. However, the truly consequential development, the narrative that will shape the trajectory of this bullish market over the next 6 months, unfolded just a few hours ago in London. For 40 years, London has been the epicenter of precious metal price suppression. The London Bullion Market Association is the nexus for major bank transactions. It is where price benchmarks are established. Historically, when prices escalated excessively, London would inject substantial supply into the market. They functioned as the seller of last resort. Whenever New York experienced a surge in buying, London would calmly liquidate assets, thereby moderating the market. But today, London did not sell. London became a frenzied buyer. As the market opened in the United Kingdom, we observed substantial and assertive buy orders flooding the trading platform. This signifies a fundamental change in market behavior. It is analogous to witnessing a firefighter deliberately dousing a blaze with flammable liquid rather than water. What prompted this change in position? Why are the bullion banks now actively driving prices upward rather than suppressing them? It is not due to a newfound affinity for silver. Banks operate on principles of financial obligation, not ideology. Their repositioning is a direct consequence of a single, alarming metric that remains largely unseen by the public: the available supply. We frequently discuss inventory levels, but inventory and available supply are distinct concepts. Inventory refers to the physical metal stored in vaults. Available supply, or float, denotes the quantity of metal actively available for purchase. In the subsequent segment, we will reveal the precipitous decline in silver's available supply. I will explain the financing mechanisms that banks employ to suppress prices and the reasons why this system has recently malfunctioned. And I will demonstrate why the entity that historically served as the seller of last resort has now become the primary buyer. The bear trap ensnared the leveraged retail traders, but the available supply trap has now caught the major financial institutions. Allow me to clarify a common misunderstanding. Analysts with a bearish outlook often cite the LBMA vault data, asserting, "Observe, there are still 800 million ounces within the London vaults. There is no scarcity." Their assertion regarding the quantity is technically accurate. However, their interpretation of its significance is entirely erroneous. This 800 million ounces represents an iceberg. The vast majority of this metal, estimated at 85 to 90%, is already committed. It is held by exchange-traded funds. It is owned by sovereign wealth funds. It is in the possession of family offices that vaulted it in 2010 and subsequently misplaced their access. This metal is not available for sale. It represents strategic reserves. It sits idle, accumulating dust. It does not move at $30, nor will it at $60. The only quantity of metal that influences price is the available supply. This encompasses unallocated metal. It is the metal held within dealer inventories, which can be leased to refiners, sold to companies like Apple, or delivered to end users. Historically, the available supply was substantial, amounting to hundreds of millions of ounces. However, over the past 3 years, as India has acquired significant tonnages, they did not purchase ETF-held metal. They acquired from the available supply, effectively depleting dealer inventories. Consequently, today, while the London vaults may still contain substantial quantities, the readily accessible portion, the available supply, has vanished. This has precipitated a liquidity crisis. Should a company like Samsung require 1 million ounces today, they cannot simply purchase ETF-affiliated metal. They must procure from the available supply. However, this supply is depleted. Therefore, the price must escalate sufficiently to incentivize holders of long-term positions to divest. This price point is unlikely to be $60, and perhaps not even $100. We are currently in a situation where the readily available supply is effectively non-existent, despite a seemingly robust total supply depicted on financial statements. This is the underlying reason for London's panicked reaction today. The banks, seeking to depress prices by accessing dealer inventories, discovered them to be empty. To comprehend why the banks are now acquiring assets, one must understand the leasing market. This constitutes the opaque core of silver transactions. Bullion banks do not merely stockpile silver. They actively lease it out. They extend silver as loans to industrial consumers such as refineries and electronics manufacturers. The recipient utilizes the silver and commits to its return at a later date, along with accrued interest. This system enables industrial operations to proceed without outright acquisition of the metal. Furthermore, it allows banks to generate revenue from their holdings. Crucially, it artificially inflates the perceived supply. The same ounce of silver can be leased, returned, and subsequently released. This creates the illusion of market liquidity. However, herein lies the challenge. What transpires if the industrial consumer utilizes the silver? For instance, if it is incorporated into a solar panel or a missile. They are then unable to return the original metal. They are compelled to enter the open market, procure a new bar, and present it to the bank to settle the lease agreement. For years, this process was straightforward. Silver was comparatively inexpensive, but now refineries are experiencing operational disruptions. The available supply has been depleted. Industrial users are contacting the banks, stating, "We are unable to return the leased metal. We cannot source any to purchase." This leads to a surge in silver lease rates. When lease rates escalate, it signifies a market-wide shortage. It indicates that banks are in a desperate situation to recover their physical metal. Today we are observing indications that the leasing mechanism has faltered. The banks are realizing that the metal they leased out is permanently unavailable. It has been consumed. It is now installed in a rooftop in Germany or integrated into an electric vehicle in California. Consequently, the banks are facing a deficit on their balance sheets. They report silver assets on their ledgers, yet their vaults are empty. To rectify this situation, they must engage in the spot market and acquire physical bars to substitute for those that have been consumed. This is the essence of the London pivot. The banks are not speculating on an increase in price. They are urgently attempting to rectify the shortfall in their vaults before regulatory scrutiny intensifies. They are effectively covering their short positions on a physical level. This purchasing activity is devoid of price sensitivity. The specific price, whether $63 or $65, is immaterial. Their imperative is to secure the metal to balance their accounts. This represents an exceptionally potent form of buying pressure. There exists a further dimension to the panic observed in London: the unallocated account. Numerous affluent investors and institutions maintain their silver holdings in unallocated accounts within London. This implies that you do not possess ownership of specific silver bars. Instead, you hold a claim on a pool of silver managed by the bank. It is akin to depositing funds in a bank. You do not own the specific banknotes, but rather a claim on the bank's overall liquidity. For decades, banks have operated a fractional reserve system for silver. They might retain 100 ounces of physical silver for every 500 ounces of claims they have sold. Their assumption was that not all clients would demand their physical metal simultaneously. However, the news regarding Samsung and the volatility experienced on Friday have instilled apprehension among significant investors. Family offices are beginning to express concerns, stating, "We no longer trust the unallocated accounts. We wish to convert to allocated holdings. We require our specific bars. We need to verify the serial numbers. We want them transferred to private secure storage facilities." This represents a bank run on silver. When a client transitions from an unallocated to an allocated account, the bank is compelled to withdraw 1,000 ounces from the general pool and assign it to that specific client. That silver is consequently removed from the available supply. If the bank was operating on a fractional basis, holding only 20% in physical metal, and 30% of clients demand physical allocation, the bank becomes insolvent. They are then forced to rapidly procure the missing bars from the market. This is precisely what has fueled the rally this morning. It is a silent bank run. It is not characterized by individuals queuing at a coin shop, but rather by billionaires issuing formal demands to bullion banks, requesting the physical segregation of their assets. And the banks are actively acquiring assets during the price decline to fulfill these demands. They attempted to depress the price on Friday to deter such actions. This proved unsuccessful. The demand for physical allocation actually intensified over the weekend. Consequently, the banks are now compelled buyers. Therefore, we have the bear trap. We have the London pivot and the leasing crisis. The stage is set. We are currently trading in the vicinity of $63.35. Directly overhead lies the psychological threshold of $65. If we breach $65, the chart opens up considerably. There is virtually no resistance until the all-time highs are encountered. In the subsequent segment, I will present the technical roadmap for the week. I will explain why $65 represents a critical level for short sellers, and I will provide a precise forecast of what to anticipate when the United States market opens in a few hours. Will American investors join the buying frenzy, or will the Federal Reserve attempt one final intervention? The available supply is depleted. The banks are cornered. The squeeze is imminent. Let us examine the charts in the next segment. If you have been following this analysis, you are already familiar with the fundamental factors. The bear trap has failed. London's available supply is exhausted. Physical buyers are now dictating market direction. However, we must now turn our attention to the technical indicators, because even amidst a supply deficit, prices do not ascend in a continuous straight line. Movement occurs through a series of engagements, and at this precise moment, the entire silver market is focused on one specific figure, $65. We are currently trading around $63.35. We have successfully recovered the losses incurred on Friday. However, $65 represents a distinct level. $65 is not merely a resistance point. It is the critical juncture for short sellers. In the subsequent segment, I will elaborate on why the banks will fiercely defend $65 this week. I will explain the dynamics of a gamma squeeze, a hidden force within the options market that possesses the potential to drive prices vertically should this barrier be breached. And I will provide a precise outlook for the upcoming opening of the United States market. The easier phase involved the price rebound. The more challenging phase is the breakthrough. Here is the projected course of action for the next 24 hours. Why is $65 of such critical importance? Is it a matter of chance? No, it represents a significant liability. Within the derivatives market, speculators purchase call options, which are essentially wagers on a price increase. Currently, there is a substantial concentration of open interest at the $65 strike price for the December and January contracts. Millions of ounces represent bets on a breach above $65. Herein lies the predicament for the banks that sold these options. If silver remains below $65, these options will expire worthless. The banks retain the premium, thereby securing a profit. However, if silver surpasses $65, the banks become obligated to deliver millions of ounces at a discounted rate. This precipitates a phenomenon known as delta hedging. As the price approaches $65, market makers experience increased apprehension. Their automated trading algorithms compel them to purchase silver futures as a protective measure against their risk exposure. For instance, if they sold a call option covering 5,000 ounces, they might be obligated to purchase 2,000 ounces of futures to maintain a hedge. However, here is the crucial aspect. Their purchasing activity drives the price higher, which in turn intensifies their apprehension. Consequently, they are compelled to acquire even more futures, further escalating the price. This process is termed a gamma squeeze. It constitutes a self-reinforcing feedback loop. It was the mechanism that propelled GameStop and Tesla to their extraordinary price movements, and it now looms over the silver market. Should we witness a breach of $65 accompanied by significant trading volume, market makers will transition from a neutral stance to that of mandated purchases. They will be compelled to chase the price to $66, $67, and $68, simply to mitigate their exposure. This is the vacuum effect we have discussed. Above $65, the market environment becomes less constrained. Resistance diminishes as former defenders transform into active buyers. This is why we anticipate considerable price volatility in the vicinity of $64.80 or $64.90. The banks will deploy every available resource to prevent this critical threshold from being crossed. They will engage in synthetic selling. They will trigger stop-loss orders. However, if the persistent physical demand from London and Asia continues to exert upward pressure, the dam will inevitably break. We are approaching the opening of the United States market. This is the critical juncture. Historically, the United States market opening has often been the point where rallies falter. For years, we have observed a predictable pattern. Asia buys, London buys, and then New York opens and aggressively suppresses the price. It is almost a clockwork event, the 10 a.m. smash. However, today feels different. The reason for this divergence: American investors are becoming aware of the same information that triggered panic in London. They are reading reports about the Samsung battery initiative. They are observing rumors concerning Chinese exports. And crucially, they are witnessing the positive price trajectory on their charts. Americans are inclined to follow momentum. When they see silver appreciating by $1.60 overnight, they do not perceive it as excessively expensive. Instead, they feel a sense of apprehension about missing out. The fear of missing out is a potent psychological driver. It is highly probable that we will witness a substantial influx of retail investment into exchange-traded funds at the market opening. This inflow of capital necessitates that the ETFs acquire physical metal to match the increased demand. This adds another layer of buying pressure atop the existing bids from London. However, there is a counteracting force: the United States dollar index. The Federal Reserve and the United States Treasury monitor the silver price with considerable attention. A runaway silver price is often interpreted as an indicator of escalating inflation, thereby weakening the perceived value of the dollar. It is common during United States trading sessions to observe a rapid appreciation in the dollar index, intended to temper commodity price increases. The confrontation at the US Open will pit the FOMO, fear of missing out crowd, against the dollar defense force. Should the price remain stable through the morning session without a significant downturn, then short sellers will face considerable challenges. This would indicate a failure of the dollar's defense and signal that American investors have joined the global rush. Pay close attention to trading volume. A surge in volume accompanying rising prices suggests a genuine rally. Conversely, if prices climb on minimal volume, caution is advised, as it could be a deceptive maneuver. However, considering the bear trap scenario established on Friday, the odds appear to favor the bulls. There's one more crucial indicator to monitor today: the mining stocks. On Friday, as silver prices plummeted, mining shares experienced a severe decline, with companies like First Majestic, Pan American, and Hika dropping by 4% or 5%, as if the world were ending. Yet today, silver has rebounded. Logically, mining companies should see a substantial increase at the market opening. If silver reaches $6.35, these companies will be highly profitable. However, mining stocks often trail behind the physical metal during market transitions. Wall Street tends to be slow, awaiting confirmation to ensure the silver rally is not a false signal. This creates a temporary arbitrage opportunity for perceptive investors. If silver maintains its gains, mining stocks are compelled to follow suit. It's basic arithmetic. The relationship between the metal's price and the stock price is stretched to its limit. When the U.S. market opens, observe the Junior Silver Miners ETF. If silver climbs by 3%, SLJ should ideally rise by 6 or 7%. If CLJ only gains 2%, this presents an opportunity, signifying that the stocks are undervalued relative to the commodity they produce. This discrepancy arises because equity traders are apprehensive, recalling Friday's events, while commodity traders understand the reality of the shortage. Eventually, equity traders will engage in panic buying of miners, making the catch-up trade potentially explosive. Therefore, we have the groundwork laid: the $65 gamma resistance, the US FOMO surge, and the mining stock recovery. The upcoming 24 hours promise significant volatility, with sharp upticks and downturns. However, it is imperative to maintain a broad perspective. Whether silver concludes the day at $63, $64, or even $660 is significant for traders, but for investors, it is mere distraction. The underlying forces driving this movement, the Samsung battery development, the influx from China, and the depleted reserves, are not short-term trading factors. They are structural shifts that persist beyond the market's closing bell. In the fourth segment, concluding this market analysis, I will broaden the scope, present a year-end price target informed by this new momentum, and equip you with the psychological fortitude needed to navigate the volatility of the ensuing week. The bear trap has sprung shut. The rocket has successfully launched. Now, we simply need to hold on. We have reached the conclusion of this market alert. We have examined the bear trap that failed on Friday. We have revealed the London pivot, where financial institutions shifted from sellers to buyers. We have analyzed the gamma resistance at $65, which is currently showing signs of strain. However, I now wish to zoom out. It is easy to become engrossed in the minute-by-minute price fluctuations, to obsess over whether silver has risen by 2% or 3% on any given day. But the most critical signal is not the percentage gain. It is the underlying structure. The market has just conveyed a profound message. $61.50 represents the floor. Consider this. A few years ago, $30 was the ceiling. Now, $61.50 is considered an attractive price point for billionaires. The entire valuation framework for silver has been fundamentally altered. As we approach the end of 2025, we are entering a distinct seasonal period that benefits bullish investors, known as window dressing. In this final chapter, I will elucidate why hedge funds, which have been bearish on silver for a decade, are poised to become your most valuable allies. I will explain the concept of the pain trade theory and provide you with the ultimate strategy for navigating the remainder of December. The bear trap did not merely snap shut, it permanently sealed off the era of low prices. We are in the latter half of December, a critical period for Wall Street as it marks the end of the fiscal year. Hedge funds and mutual funds are required to submit their annual reports to clients, detailing their holdings. Consider the psychology of a fund manager. If silver is the standout asset of the year, experiencing significant gains driven by technological advancements and shortages, and the fund manager holds no silver, they appear incompetent. Their clients will inevitably question their investment decisions, asking why they did not participate in the best performing asset. This can lead to termination. Consequently, during the final 2 weeks of December, they engage in window dressing. They acquire top-performing assets at any cost solely to showcase them on their year-end balance sheets as of December 31st. They aim to demonstrate their participation in the rally by stating, "Look, we own silver." This creates a substantial, artificial upward pressure leading into the year's end. Funds that overlooked silver at prices of $30, $40, and $50 are now compelled to purchase it at $63 simply to maintain their professional standing. Price is not a primary concern. The acquisition of the position is paramount. This institutional FOMO is the catalyst for parabolic price increases in late December. We have witnessed this phenomenon with technology stocks in the past, and now it is occurring with commodities. The news from Samsung provided the justification, and the price action supplies the urgency. Therefore, if you observe silver appreciating on low volume during the holiday period, do not be surprised. It is the astute money attempting to appear prescient after a year of misjudgment. And you, having acquired silver at $25 and $30, are now selling your overvalued holdings to these desperate funds. Or ideally, you are choosing not to sell at all. Markets are inherently harsh mechanisms, designed to transfer wealth from the majority to a select few. They typically move in the direction that inflicts the maximum pain. Presently, ask yourself which outcome would cause the greatest distress to the largest number of people. Scenario A. Silver plummets back to $50. Who would this harm? The ardent silver advocates. However, silver enthusiasts are accustomed to hardship. They have endured decades of market suppression and do not divest during downturns, but rather increase their holdings. Thus, a crash would not generate liquidity, but would instead tighten supply further. Scenario B. Silver surges to $75. Who would this disadvantage? Firstly, the banks holding hundreds of millions of ounces in short positions. Secondly, the industries reliant on silver for solar power and batteries. Thirdly, the general public holding cash while inflation erodes their savings. Fourthly, the professionals, specifically hedge funds that are underallocated to commodities. Scenario B would inflict maximum pain upon the established financial order, destabilize bank balance sheets, compel industries into a state of urgency, and humiliate professional investors. Consequently, according to the principles of market sadism, Scenario B represents the most probable outcome. The market seeks to penalize short sellers and drive uninvested capital to chase escalating prices. Friday's bear trap was the final attempt to dislodge you from the moving train before its departure. If you remained on board, you aligned yourself with the pain trade, becoming the inflictor of pain rather than its recipient. Let us conclude by adopting a macroeconomic perspective. Why is this $160 movement significant? Because it validates the wealth transfer. For 40 years, wealth has shifted from tangible assets to financial instruments, from manufacturing to derivatives, from gold to government bonds, and from silver to technology stocks. That trend has reversed. The Samsung battery is more than just a gadget. It is evidence that the physical world is regaining its value. You cannot synthesize a battery. You cannot manufacture a solar panel. These require extraction. When the price of silver experiences a sharp increase while the bond market shows signs of instability, it signifies the market's endorsement of tangible reality, asserting that an ounce of silver, requiring labor, energy, and geological processes to produce, holds infinitely more value than a digital entry on a central bank's ledger. You are witnessing a historic inflection point. Your descendants will inquire about your actions during the resource crisis of the 2000s. Did you hold paper assets or physical commodities? Friday served as a test of your conviction in that belief. If you persevered, you have passed. Monday is your reward. The day the bear trap failed. The day London experienced panic, and the day the path to $65 was cleared. I offer one final caution. Our current success does not signify the end of the conflict. Volatility will intensify. $2 price swings will escalate to $5 swings, and $5 swings will become $10 swings. You must strengthen your resolve. Excessive leverage will lead to your expulsion from the market. Constant attention to price fluctuations will induce stress. The strategy remains straightforward. Accumulate physical silver and secure unhedged mining stocks. Remain steadfast. The market is working in our favor. The shortage is working in our favor. Samsung and China are working in our favor. Allow the sophisticated investors to pursue price momentum. We are already positioned. Congratulations to those with diamond hands. Enjoy the rally. Subscribe.